You just got to suck it in, baby. All right, so today I am going to share with you a roadmap that works every single time to find at least $1 million. Does anybody in here want to find $1 million? So this is the crazy thing. Over my career, and I've done everything from startup to $20 billion in revenue, as you heard, and my first business I owned when I was 18 and I sold it when I was 21. Everything I'm going to share with you today, I didn't do any of it. And I got to tell you, it really cost me. But the thing that's also going to drive you nuts is everything I'm going to share with you, I am certain you've heard before. And I like to call myself the master of the obvious. It's sitting right in front of us, and we're just letting it spill out because we're off chasing the next deal. We're off chasing the next things, and there's all this money, and it's just spilling out. That's why I wrote the book that I did after watching and looking around and seeing all the other entrepreneurs and even the big companies. The bigger the company, the bigger the leaks. I realized that every single company had the same 15 leaks. We just had different degrees of those leaks. So I'm going to teach you about that today. One thing I am certain of, there's no doubt in my mind that every one of us, and I'm going to include me in that as entrepreneurs, have a lot more growth potential, revenue, profits, and life than we ever imagined. And it's right there, and we are squandering a bunch of it. So I want to help you recapture that. The other thing that I learned, and I'm certain of, is when we have a framework like EOS, my process, and all of that, when we have a good leadership framework, it actually takes us down to the promised land. So I'm going to give you a piece of our framework that works every time, and it's going to show you the way to go. So you got my bio, but here's the thing. I'll start with a story. So there's a client here in Phoenix, comes to me, and Russ Palmer, he's the owner of Titan Restoration. Russ comes to me and says, Howard, I'm frustrated. Why are you frustrated? He says, it's taken me 20 years to get to $7 million of revenue. And while he was proud of it, and he had done a lot, and he was considered one of the larger people in his industry, he knew they were capable of so much more. And then as we talked longer, and you already heard this, and now a little bit earlier, is he realized that 80% of the work was just coming from a few people in his company. Him and a few of the leaders. They were working their tails off. And he realized if he was going to get to the next level, he had to figure out how to make everybody else work harder. And the part that really stunned him is I told him, I said, you and the other owner should be the least busy people in this company. And he looked at me, we got this all wrong. And by the way, I had this all wrong. And this is what led me down this path. This is what got me on this stage. So I could totally appreciate his pain. He's like, we're the ones doing all the work. We got to get all those other people to be doing all the heavy lifting. And that's what we switched. And I'm going to tell you a little bit about that in a second. But I don't want you to get stuck behind this bio. All right? There's always a backstory. And I think the backstory is important because if there's a mistake, I've made it. And if I haven't made it, I'm certain I'm going to make it over the next few years. So when you look at this, I've generated over $1 billion worth of value. I've been in the boardrooms, not of the companies that were up there, that was a different group, but Ryder, AutoNation, KPMG, big, huge companies, and help them grow. But here's the backstory. The backstory is, let's go back to that first business. I bought it when I was 18. I sold it when I was 21. On paper, you think, that's awesome. 21 years old, you sold your first business. Guys, I want a do-over. Knowing what I know now, geez, I would have sold that company for so much more. I would have made so much money along the way. And I was actually proud of the 100 hours a week that I was working every week. I would actually go to people and say, I work 100 hours. I'm freaking awesome. Man, now I look back, do-over. I want it. I mean, terrible. So going back to Titan, all right? So Russ comes to me, tells this story, and all of that story that I shared with you led to me building a framework. And my second best-selling book that just came out recently, The Leader Launchpad, we actually built the system in there. We realized that there was a better way to do things. There was a better way for us as owners to have freedom. There was a better way to, the whole thing about working smarter, there was a way to do this. It was out there. So we collected all the best practices of about 50-plus business books, the EOS, scaling up, all of that. It's all built in there. And then we're like, we got to simplify this. So you're going to see I've simplified this. Fast forward, so we take Titan through that system, and that's exactly what they needed. They needed a consistent growth strategy. They needed to unlock the potential of everybody else in their company. And I'm proud to say they went from 7 million to 22 million. They got their profit to 5 times the industry average, all right? And then the best part is we measured engagement score, just like what Jared shared with you, and it tripled. So it's no secret they tripled as soon as we tripled the engagement of everybody else and got those people to do the heavy lifting. My favorite part is I get a phone call from the number 2 person, Rachel, in the company. Rachel calls me up, and it's 2 o'clock in the day here in Phoenix. And I'm like, what's up? She says, I'm struggling. I said, why? She says, I got nothing to do. Swear to God, she calls me up. She says, Howard, I don't know what to do. I said, this is why we got to this point. Now you can do the strategic things. And that was their ability to kind of now really go to a whole nother level. So I'm going to share with you the center of all of this. So when Jason said, listen, Howard, I not only want you to teach them what the leaks are, I want you to teach them the financial statements. I went like this. I said, I got to be honest with you guys. I wound up studying accounting because that's all of the financial stuff is what I ignored in my first business. And then I realized if I really wanted to master things, I better figure this out. Then I even went to school in accounting. I never went to class. My wife asked me about 4 years later, when did you go to class? I didn't. I took tests. And that's how I got through it. And I knew I didn't love it. I went out and I did it, but I realized as a business owner, we've really got to get these concepts. So the first thing I want to teach you is how to look at your financial story differently. See, one thing I know about entrepreneurs is when we find the right problem, we solve it. But if you don't see your financial story in the right way, you're going to solve the wrong things and you won't go like this. So the first thing I'm going to do is that. Then the second thing I'm going to do is I'm going to make sure you know what the leaks are, and I'm going to explain that in a few minutes of what I mean by leaks, because they're not in those financial statements. And then the last piece is I'm going to show you how to prioritize the stuff you've written down today. Who's in? You're still in. That's awesome. I'm glad. I haven't lost you yet. Once I get into the financial stuff, we'll see. So the first thing I realized is for any of us to get this, the success we need out of sitting through these programs is you need an open mind. Who here thinks they have an open mind? God, I love that sense of humor. See, the last time you truly had an open mind was when you were born, and we've been screwing it up ever since. See, the problem is the more success you have, the more things you learn, the more experiences you have, the less curious you get. Your ego gets in the way. You want to be efficient. You think you've been there. You need to be right. And because of that, we don't have the same curiosity, and that's where the leaks come from. All right, so I'm going to teach you an example of this right now. So you remember in grade school they taught us 1 + 1 + 1 always equals 3? So I'm going to show you a situation where it's not. See, after looking at thousands of financial statements in all the companies I've worked with over the years, I realized that when you improve a financial statement, 1 + 1 + 1 equals a lot more. So this was also this is a real client's P&L, and the first thing I did with them, for those of you who may call it an income statement, that kind of stuff, I'm going to make sure I don't use jargon and make sure everybody will all understand the same thing. So I go to them, and they had grown 52% the previous year. And what I wanted to show them was, and by the way, they barely made almost any more money. It was almost flat with the previous year. So they grew 52%. I said, listen, this year, if we just grow your top line by 1%, if we expand gross margin by 1%, and we reduce selling general and administrative expenses, some of you call that overhead, at 1% as a percentage of revenue, their bottom line would move 42%. See, simple moves, all right? We don't have to dramatically change our business to dramatically change how much cash we keep in our business. And that was kind of the big lesson I want to make sure you guys take away. Revenue is vanity. Profit is sanity. Cash is king. We've all heard it. And then we all go chase revenue. And we get real excited about that big number. And I can't tell you how many companies I meet got this huge number, nothing to show for it. And I want to change that for you. Now, fast forward. Another great story. This company, 12 months later, 20% net profit. Still growing, not as fast, highly profitable. They were going to go bankrupt. And they could not see their financial story. And they, by the way, had a really expensive CFO who needed to be fired. But the challenge is they were doing too much. So we're going to start with illuminating the story. Bear with me. I'm going to try to make this so everybody understands it. I'm going to try to tell stories. It's not sexy, folks. I wish I can make it sexy. Maybe I can dance up here a little bit, make it good. But financial statements are not. And the thing is us as entrepreneurs, we're more excited about building the score and thinking forward than we are looking backwards and figuring out what we can understand from where we are at this point. So that's why this is not sexy. And one of the things I am going to challenge with you later is getting better at forecasting, getting better at predicting. So the first thing I want you to realize is when you're looking at your financial situation in your business or your life, I want you to treat it like a really good novel. All right, when you've got a good novel, we've got to go from the first page to the last page. We've got to know all the characters, all right? We've got to know the inroads. We've got to know the stories and all of that, and that's what drags us in. Well, the same thing with our financial statements. Most of you probably only look at an income statement, right? And it probably is not what you need to see. You're probably not even structuring that correctly, so that's what I want to do. So for you to see your story in its entirety, there's 4 chapters. So the first one, most of you already look at, and I want to hopefully share with you a few things that's going to get you to look at profitability differently. Then I want to teach you about working capital, all right, and what that means and what that story tells you. Then I want to talk about the other capital and what that story is, and all of this you're going to understand what it means. And then the last thing I want you to understand the funding chapter. It's only after all 4 chapters that you can weave together the stories. Too often we see one thing and we go and jump, but it's not what we need to see. So I'm already going to warn you, really small type. You're not supposed to read it. You don't need to see any of the numbers. The numbers themselves don't matter. What matters is what we need to look at. So the first thing we normally look at as business owners is revenue, right? And we're like, did it grow? How many of you actually track your revenue percentage growth rate and see if it's consistent? See, very few hands. Highly common. It's very important that we understand that percentage growth rate and to see that's going. So first of all, when you get bigger, in the old days, $1 million growth was nothing. Well, now $1 million isn't enough to keep that percentage growth rate. What percentage growth rate tells us is how well our business model is working. So when you're growing the way you should in the market, you should be growing 2 to 3 times the growth rate of the industry. So one of the problems you all have right now is you're fat and happy. All right? You have the wonderful thing about the market is it can make us look smart or it can make us look stupid. Right? So right now, all of you look brilliant. The challenge is how many of you in this room are growing 3 times faster than everybody else in this room and consistently doing that year after year. So we look at that growth rate, and then we need to understand what that growth rate story is telling us. If it's going like this, now I do understand there's aberrations in industries and stuff like that that can cause that, but for the most part, it should just consistently go like this and start going like this. And when it's not, we have to keep challenging ourselves not to be too, caught up in our success. Because definitely growing is success, definitely profit success, but you need to look at that because it tells you about your business model. The next thing you need to look at is gross margin. So I've had a number of clients start freaking out because their payroll is going up a lot. I'm like, this is an awesome thing. They're like, what do you mean it's awesome? Look how much more money I'm spending. I'm like, yeah, but your percentage of gross margin, your direct costs, are actually lowering as a percentage of revenue. You're actually making more money. Don't worry about that labor line. You're actually a better business. Now, if your gross margin percentage is shrinking, we've got a problem. So this story that I'm taking you through is all one company. We worked together with them for 1 year, and you're going to see how their growth rate changed, and it's accelerating right now. You're going to notice a big thing in gross margin. 36% gross margin when we met, finished after 1 year, 50% gross margin. So that means the amount of money they're making is a lot more than the growth in that revenue. I'm super excited about that. And we're going to talk about how we came about that. So watch that gross margin rate. When it starts slipping, you got a problem. When it's expanding, you want to harness what you're doing, that you're making your platform so that you're getting, better scale in your business. The next one is overheads. So one of the problems I see, and now I'm going to stop here. So most of you in this room probably don't even split up your income statement properly. You have revenues and you have expenses. You need to see revenues minus direct costs, which equal gross margin, and then you need to see what overheads are. Overheads are, in most industries, selling, general, administrative. In your industry, sales and marketing actually, for most of you, should be in your direct costs. And the reason we need to see this is your direct costs should move in correlation with your revenue. So when it doesn't, you've got a problem, but you should expect, if you're growing, that number is going to grow pretty consistently with it. Unless you change your business model, that percentage should be the same. Overhead is a different story. So your overheads, your general and administrative expenses, should be shrinking as a percentage of revenue as you grow. And usually what happens when we sit with a business is growing at the same rate. It means, folks, when people talk about scaling your business, you have no scale. It means all that extra money you made, you just gave it away. And by the way, usually it's all on payroll. You're adding payroll too fast, you're throwing bodies at stuff, and you're destroying all of that extra wealth you were creating. So as you scale your business, this percentage should shrink. Then you get to a plateau. You got to get to the next level like Ren and Jared did. They had to add a management structure because the people that got them there, got them to where they were, won't get them to where they needed to be. You make the investment. Now you'll see that percentage actually go up, bad on the surface, but you got to understand we just built to grow. So now we're going to hopefully triple at least this year, and all of a sudden they're going to have a ton of profit margin. So you've got to understand your numbers. You've got to understand how they work. Understanding these levers are very, very important. Just out of curiosity, did any of that resonate with anybody so far? Because I'm going to have you circle something you need to learn. You need to walk away with every cent. The other thing is, as I started looking at it, I needed to see trends. So I like bar graphs. I like charts. I'm going to show you another one with a line graph. So you can see with this particular company, even though you can't see the numbers, you can see all the way on the left, that's their gross margin percentage. So they were 37, 39, 38%, pretty consistent over time. And then we fixed it, 50%. Wow. So now our job going forward is to either stay at 50 or keep going. The other thing that we did is we actually reduced overhead. So if you see in the bottom the orange and the yellow lines, so the yellow bar is actually growth rate of revenue. The orange bar is actually growth rate in overhead expenses. We actually shrunk the actual dollar amount of expenses, and we grew by 19%. So now they got the benefit. Remember the 1 + 1 + 1? So this company went, so you'll see in the bars all the way, well, the ones in the middle and to the right is how much net they had. They had not made money in 3 years. So this last year now they finished with 18% net, and now this year they're going to do over 20. All by figuring out the stuff that goes in. So how do you figure out the stuff in between? Definitely I want you to look at revenue versus overhead growth. So scary thing here. They have a lot of lines of business. They're in the restoration industry just like Titan. Fires, floods, in your house, your business, you call these people, they come out. They've got a lot of services. Well, what we figured out is we want to make sure we're growing all the services. We want to grow the higher margin services. We want to make sure that we're doing well in every one of the business because you've got different leaders running each one of these departments. So which leaders are doing their jobs and which leaders aren't? So if you have people managing different operations, you got multiple locations, multiple product lines, it can get hidden in that central income statement that some leaders are not performing and some are. By looking at gross margin by product line, you can learn a lot. So what we did with this one, and I'm going to pivot this to another story, you're going to see, so their largest line of business generates 58% of their revenue, but only 42% of their profit. Their smallest, one of their smallest lines of business actually makes up another third of their profit. So it's a smaller percentage of the revenue, but a much bigger slice of the profit. So that's that gold piece. So then we were like, how do we grow that gold piece? How do we grow that faster than we grow the other one? I want to get out of the other business. And that's how we moved the gross margin. The other thing is, and I'll share with you one of the things you learned from this, one of our clients in the benefits insurance industry. We looked at their numbers, we did these same pie charts, and we realized that 40% of their clients only made up 10% of their revenue. And they lost money. That 40% of clients actually took up 60% of the labor costs in the company. We sold off that piece, got rid of it. No one in the company was ever to sell that type of business again. And now you had all of that energy focused on where they made their money. They went like this, a lot more profit, and actually they started growing a lot faster because they were getting held back by all this crappy business. So by looking at pie charts, by looking at stacked graphs, by looking at history, now we're getting into the pages. We're getting into the guts. We're understanding. So now when you see it, just because you see this, now you got to go and ask more questions. You got to be curious about why the number is what it is and why it wouldn't be better. And then with most of our clients, and you guys have a great story here because you can go all the way across this room and say, what is your margin? What is your margin? How do you do this? Met somebody yesterday, 65% net profit. All of you should learn how to do that, because that's what's possible, right? So we need to know what possible is. I want you to be like Titan. I like rolling graphs. I like rolling 12 months. So when companies are growing really fast, we want to make sure that these lines are growing at the same rate. So the pink line is revenue growth for the new year, the current year they're in, and then the blue line was the revenue they were in the year. So two things we saw by looking at this graph. You're really not growing at all. And since you finished that previous year, you stopped growing. Why? Started asking questions and reignited the growth in that company. But sometimes you see the graph. Other times, you want to put graphs next to each other. So you've got the gross margin dollars on the top, and you've got the gross margin in the percentage. So this company grew, but now when you look at their numbers, they actually made less money. Percentage-wise, they were losing percentage-wise, and because of that, they were basically making about exactly the same money. So we turned that around. I was actually chief operating officer to that company. Another thing is we talk about growth. So I like waterfall charts. So most companies go in and they're like, listen, they have recurring revenue. Most of you don't have that, but this company had recurring revenue, and they're like, all right, so we're at $30 million revenue. We want to be at $33 million next year. We feel like that's very doable, 10% growth. I said, all right, but you realize, based on history and where you're at right now, you're going to lose a $4.5 million of business. Those clients are going to go away for different reasons. So you're not starting at 30 million, you're starting at 25,500,000. So your growth rate now is from there to 30 million because you're going to lose that business. You lose that amount of business every single year, and most of that's outside of your control. So now what do? So now you got to start thinking about what is the stair step to get to where I want to get to. So they're like, all right, well, we can increase volume with existing customers. With our existing products, we can increase volume. So we're going to pick up about 3 million of the number right there. And then, you know what? We're going to add a new product. And by selling that new product, we're going to add another 2 million. Oh, and by the way, we're going to do a small 2% price increase, which our clients won't really care about much because they won't even notice it. But it's worth $600,000 to us. And as you're going to learn a little bit later, that's the most valuable thing in terms of growth on the bottom line that you can do in terms of cash. And then they realize we're still going to need $2 million in new customers. So going from, hey, we just got to grow 10%, you needed to understand what's the story that is going to get you to where you need to be. So now what I want you to do, before I start telling you about working capital, is I want you to write down and commit to at least one thing I just shared with you that you're not doing that's going to help you understand income better so that you can move more money to your bottom line. Let's take 2 minutes. You can chat with your table. You've probably already written down your idea. Circle the best one. If you have too many ideas when you leave, you won't implement any of them. Go get them. Awesome. So let's get going again. Come on back. You guys did not know you were going to have a pop quiz. There's going to be pop quizzes all the way through, so you better be taking notes and taking this seriously. Thank you, thank you. All right, so remember I told you that company in the beginning where you got them to 20% net profit, but they were going to go bankrupt. They grew 52%. Their problem was sitting in here in working capital. They had never looked at the balance sheet. Actually, with all the chapters, they did not realize that they grew 52%, but they actually destroyed cash. They actually had negative cash flow. The negative cash flow was actually happening in their balance sheet. So for those of you who don't know what working capital is, it's actually looking at your short-term assets. If you have inventory, work in process, your receivables, your payables, those short-term things on your balance sheet, the stuff that you need to fund now, that's the stuff that's in there. And what I want you to do is don't look at the absolute numbers. You know, I had a client a few years ago, and all he ever looked at was the receivable balance. And he's like, man, I need to get that number down. I need to get that number down. And when it would go up, it'd go crazy. And I'm like, we're growing at 30% a year. If your team does their job, it's going to grow. It's not a bad thing. Now, it's a bad thing if your days change. So what you want to look at is you want to look at that receivable balance and get days receivable outstanding by comparing it to your revenue balance. And when you do that, it calculates the number of days. So when days go up, bad thing. When days go down, good thing, right? So it means that from when we spend $1 and get it back, we're getting the dollar back quicker. We're getting it in our pocket quicker so we don't have to go and get financing or anything to fund the growth. We're getting that money in faster. The other thing that we see in a lot of businesses is they don't realize that your payables is free financing. So I'm not saying pay everybody late, all right? Don't piss off your vendors. But you can renegotiate terms. We did a lot of this last year during COVID, and vendors were super happy to help out their customers, free financing. So we need to go out there and figure out who will do better terms with us and leverage those terms to make a better cash flow model. So when days go up with payables, good thing as long as it doesn't go too high and you're not breaking your terms with your vendors. And when it goes down, you know, maybe you have the cash flow to do it, but you're losing an opportunity to leverage cash. And then for some of you, you don't have any inventory. But that's usually a big cesspool. For that company, their inventory had tripled, and they didn't even realize it. They weren't even selling the stuff that was in their warehouses. They bought another warehouse because it was piling up so fast, and they didn't need to. Eventually, we got done. They didn't need the second warehouse. But work in process. How many of you actually do construction and actually calculate WIP? Work in process. Okay? So too many companies don't calculate their work in process. This is a huge mistake. So one of the things that's happening with a lot of you is you're keeping your books as like cash books, the way you would do for taxes. It's easier for you. It's hard to come up with what they call accruals. There's a reason why we do that, folks. We need to know the work in process because then we're matching the revenue in the same expense period. Otherwise, what happens from month to month, your income statement goes like this, and you're like, what the hell's going on? I can't make any sense of this, so the hell with it. But if you properly do your accruals, then you'll really be able to see your gross margins. You'll really be able to see the overheads. You know, how many of you in a particular month had 3 payrolls instead of 2, and your numbers went out the window? Anybody have that happen? Shouldn't happen. You do an accrual, because now what's happening is you're making one month look like shit, excuse my language, and the other month looking better than it should. You've got to match up the expenses with the revenues, and that's the only way you can tell the right story. So we need to see all of this. And in all of these cases, you notice I'm breaking it down into days. You can also, on the bottom, break it down into dollars. And what I want to figure out is I want to know how much working capital it takes to run my business. What percentage of my revenue is locked up in my balance sheet in short term? So basically what you do with that is you take your receivables and your inventory, and you subtract your payables, and that will give you your actual number of working capital days. And it also, you can do this in dollars, and it'll come up with what is the percent that you have that's locked up there. This is important. So when that percent goes down because I do a better job with collecting and I do a better job with payables, I can grow faster without getting funding. When that number goes up, sometimes I'm having trouble making payroll. And what you don't realize is, and I had this happen in my business, my very first business, I was growing 100% every quarter. I did this for 3 years. And for the first 2 years, I never had any money. And I was just always robbing Peter. And, you know, any of you have tried to do this at 18, 19 years old, go to a bank and ask for a loan? It was comical. I was not getting any financing from those banks. You know, but at the end of the day, I looked at my income statement. I had this great profit margin. and no cash. And it was real simple. Here's the thing. I paid my employees every 2 weeks. My vendors were paying me my customers were paying me every 3 months. Now I'm growing 100%. I am just burning cash faster than I had to figure out how to solve that problem, or I would have gone out of business. Had a highly profitable, high-growth business and would have gone out of business because I didn't figure out that problem and I had to renegotiate that. So you need to understand this. So now what I want you to do is, I'm not going to show you much more than that. Now you know what working capital is. I want you to write down one thing that you may have heard that can help you and what you want to look at differently going forward. Write that down. Another couple minutes here, talk amongst your table, and I'm sure it'll be interesting. There we go. Let's bring it back. All right, so somebody in the audience, and that's really helpful to make sure this is relevant. So if you have a lot of properties, and I know we deal with this with rent, where they're backed up, and so it's tied up in a title. And hopefully you guys are keeping a list of all the deals that are in the pipeline and when you think they should close. So for me, that's a receivable for you. So the faster we can turn those properties and we get those closed, the faster you get cash. The slower, the number of days it's taking you to turn a property, if it goes up, that's a bad thing. So you need to keep figuring out, and actually one of the measures we came up there was because you're always going to have those properties that have horrible titles, and they're going to take a while. And actually, we'll talk about monetizing that when we get to the leaky bucket. But what I want you to realize is 80 to 90% of them should be turning a lot faster, and you're so busy looking at the bigger nut or the overall dollars that you should be asking yourself, what percentage of them close, and I'll make up a number, in 7 days. From when we get to 7 days, how many do we do? And you can keep setting up days of a large portion of this. You're spinning faster. By the way, customers are happier, and you're going to be doing much better doing that because the money's flowing quicker. It's good for everyone. So I would even break down that balance, just like I do gross margin and all that, and saying which of the tranches should be in X number of days, which of the tranches should be in these days, and really understand that, and then challenge your team, how do we speed up each tranche? So hopefully that's helpful. Thank you for sharing that. That was really good. So the last piece, and this is just another chart, and that's why I didn't go there. It just shows you the days next to each other and the movement. And usually I like to see red, yellow, red or green. So green is it did a positive movement. Red is negative movement. And it's just another way to look at the same stuff. So now let's talk about the rest of your balance sheet. So, usually companies are really focused on, so in this case, you're trying to turn those properties. You're really focused on that. Where you might get into trouble is you're not looking at the rest of the assets, the other things on your balance sheet. So what you want to do here is now the other capital is looking at all those long-term liabilities, all those long-term assets, fixed assets, properties you actually own, all right? And is actually seeing now what that looks like relative to the right items on your P&L. And so we want to, but the main thing that I want to learn here is I see too many people taking money out of their business too fast because they're like, it's risky. And I'm like, all right, well, I'm looking at your return on capital. And it's, in this particular case, my client, before it was negative. Remember, they weren't making money. But now it's 77%. This guy was ready to exit. He's just like, I'm tired, I'm exhausted. I'm like, now if we can keep, for every time you invest capital in your business, would you spend $1 to get 77 back? Anybody in here would do that? Yeah, but if you don't know what that is, it's really important. See, if that percentage is too low, and then you go out and you borrow money, so let's say I borrow money at 8% and my return on capital is only 5%, you've got a bad business model, and you better figure that out. You need to be able to get the proper return on capital. So one of the things I like to do, and the reason I like this chapter, is I want to know if I have assets, how quickly I'm turning them. If I have money invested, equity, or assets and equity in the business, what kind of return am I getting in that? Because I have to decide whether I still want to be in this business. I've owned 9 companies, all right, and founded 6 of them. And in every case, I just exited one last year because I didn't see the return on capital being worth my risk. If I'm going to take huge risk in a startup-y company, I want at least a 25 to 30% return on my investment, at least. And if I can't see that and I can't predict that, I'm going to take that money, I'm going to move it somewhere else where either it's less risky, lower return, more guaranteed, or somewhere else where I feel much more confident that I'm at least going to get my 30% return, my 25% return. Does that make sense? So I'm not going to make you guys break out on that, but I want you to go back and I want you to start thinking about return on investment, return on the stuff you keep in the business, and sometimes we want to expand faster. In a market like this one, I'm thinking about, I want to capture as much of that goodness as possible and move quickly as long as I'm getting the proper return. The last thing is a lot of companies confuse EBITDA with cash flow. And so all I want to do is I want to show you on this a couple things that I look at when I look at funding ratios in a business. So the first thing is I want to see gross margin, and then I want to see that versus the working capital it takes me to run the business. So the bigger the spread, the better my business. The better my business model when I'm turning a lot more money than I have to keep and fund the business to grow it. So I'm always looking at how to expand that. I want to know what the operating cash flow is. So the problem is net cash flow can change for a lot of reasons. I'm going to show you in a second a real cash flow statement. So what will happen is operating cash flows should closely approximate the profit on your income statement, and I'm going to show you why it won't. But if everything else being equal and everything else is working the way they should, those should be equal. But then we make decisions like dividends. We're going to give ourselves money back. Too many companies, the leaders are just saying, wow, look at this fat profit. I got $1 million worth of profit. I'm going to take 50% of that. They're not looking at what's going on the funding on their balance sheet and this is why a lot of companies get in trouble. The other thing is we invest in things. We decided we want to start holding the damn buildings. Or we're going to hold properties. So you may be making profit, but you also may be sucking up all that cash, and you've got to think about how much cash that's sucking up and how you're going to fund it and how you're going to finance it. So I want to know what my operating cash flow is, and I want to know my net cash flow, and I want to know what's driving in between. So when I'm making my dividend decisions, I'm looking at the whole story, not just, hey, I made this much profit, I deserve X, and I've made that mistake. The other ratios are common. I don't want to do that. So what this shows you, which is different, is the two reasons why your income statement and cash won't equal in operations is what's happening in your changes on those short-term assets and liabilities. So if I speed up my payables, I will pay out more money in this current year than I actually show as expense on my P&L because I'm now paying out faster. When my receivable days slow, so in this particular case, both their payables changed and their receivables changed, you're going to see that there was almost a $400,000 difference between revenue that was on the income statement, real revenue, and collected revenue. And then when the expenses were there, so those direct costs, they actually had $245,000. They paid some vendors faster. And so by doing that, it actually sucked up cash. So instead of $1.3 million, and if you would have done dividends in $1.3 million, it would have been in trouble because they only had $660,000 of actual cash flow from operations. And then he made some decisions. He said, all right, I'm going to distribute some money to me, but then they invested a bunch in assets. So you've got to know how much you're tying up in trucks and vehicles, how much you're tying up in different things you're buying, which is, it's an investing decision, but it doesn't show up in your income statement. We've got to understand cash so that way you can get ahead of it. Then eventually you get better at forecasting and you start forecasting, this is how much cash I need this month, and when I deliver again, this is how much I'm going to need next month. Because many of you I remember meeting Sam Zell and sitting down and having a cup of coffee with him. And, this guy's done, trillions of dollars in real estate deals. He was broke his entire life. Sometimes he couldn't even pay his own personal bills almost all the way to the end until he ultimately, did his exit. So it's very common in this industry for those of you collecting assets. We've had a bunch of multifamily clients that they're always teetering. And then the only way we survive is, all right, we got to sell one of these one of these properties so that, this thing doesn't go belly up because, yes, you've got good deals, but if there's no exits, we're in trouble. So we have to understand that, and we have to understand the cash flow. So I want all of you to be producing a real cash flow statement. I want you to understand what operating cash flow is, and I want you to understand all the other ins and outs, the investing decisions and financing decisions you're making. Because the other thing that people get confused with is, just because your cash balance went up didn't mean you produced cash. Your cash balance can go up if your debt goes up, right? So I always look cash net of debt. And I want to see that that's going up. Now, in certain industries, that may not be feasible, but then I want to know how much cash I'm burning every year, because then I'm already thinking about funding well in advance. And rather than going out and do a bunch of funding rounds, I may do one big one, let the money sit on my sheet, and then I don't have to keep doing capital raises, every 90 days because I have all these new deals coming in. Just create a fund. So understanding this is really, really important. So here's what I want you to do. I want you to take back what you just had here. I want you to identify what you need to look at daily, weekly, and monthly. And it's not always the same thing. Every month or every quarter, I want you to drill into something you haven't drilled in before. One of the things that I raised with Jared the other day is I said, it would be really interesting to know the true acquisition cost of your deals. So he's got the acquisitions business, he's got he's got all 3 different lines of business, but I'm like, do you know exactly when you get done and you've actually had a deal, what is your average cost per deal? And I'm going to guess it's too high. Because if he wouldn't be able to sell those leads to other companies, those great deals that he brought in, then his costs are too high. I want to know what that is. So it'll be an interesting analysis. Once we know that, we can make decisions, we can ask questions. So you got to keep being curious. What if? What happens? And I want you to get better at forecasting. Most of you need much better financial packages for your leadership teams to make decisions. You need it fast, you need it early. By the 5th day of the month, you need to have a package that you guys very quickly have the graphs, the charts, and all of that, and you start making decisions. If your leadership team doesn't understand that, what's going on in there, they need to learn. Finance, all this financial stuff is not just the accounting department's job. It's leadership's job. That measures how well we're doing as leaders. Every single person on your team, not just the leaders, what they do or don't do moves those numbers. And they have to understand cause and effect. And when the effect is not what it was supposed to be, we've got to figure out who, what, and when. And so every month, every quarter, you should be pulling this stuff out, and it should be extracting your next priorities. So I want to make a suggestion. I'm going to open up to questions, and then we may want to cut this one early because I think we're going to do a break in between.